Hey everybody, it's Mark Yegi here. Welcome back to the channel, and I'm just going to jump right into it. I'm going to talk about a complex concept. If you're new to covered calls, this may be a little over your head, but if you understand the concept of covered calls, which is buying a stock, selling a call against it, then I'm going to give you a more of a complex concept on what I call augmentation strategy. So listen, there's a lot of people out there that say, well, you buy a stock and you sell a call against it, and at the end of the week, you just let it expire and get called away, or you whatever. I mean, I don't do that. I've been in Tesla for 3.5 years, and I haven't been called out on it. I haven't been exercised. I roll my calls every week. Sometimes that's good, and sometimes that doesn't work out so well, but over time it does. And I'm going to show you on this video why it does. But it's so critical to have a strategy, have a trading plan. And, I don't know of any other program besides my cash flow machine that goes really deep into what happens when the market goes up, when the stock goes down, when it stays sideways, when there's a dividend, when there's earnings, how to roll, roll up, roll down. There's tons of different rules that if you're not ready for them, the market's going to slap you around. And my goal is to not lose money, first of all, and then secondly, make 1% to 2% a week or 2% to 4% a month. And I've been able to do that in a lot of my accounts. And, I just like to show people how to do it because their eyes go, this is really cool. That's really fun for me. And at this age in my life, I've got some money, and, I like to teach other people how to do it, especially because I think it's like a little secret against us from Wall Street. Like, they don't tell us that this is the way that Warren Buffett makes money, and they make money in their portfolios. And sometimes pensions use it as a strategy to make money. And covered calls is great, but if you don't go deep in covered calls, it's not a full strategy. So let me get into this little bit of a complex strategy called augmentation. And this is really from my mastermind program where, it's not like your first week you're going to learn this. This is something that you're going to have to get slapped upside the head a couple of times with the market. But if you do, as I think I'll show you here, you're going to be like, this is cool. So stick around to the end. By the way, I'm going to ask you to hit the like and subscribe button and all that stuff everybody else does. But it really does help me keep making these content videos for you. I kind of like doing them, but I kind of like knowing people are watching. And by the way, those of you who have been commenting, thank you so much. That makes me feel good because I know that somebody's actually watching these things. And the channel's growing. We just got over 1,000 people. So thank you very much. Doesn't sound like a lot, but 1,000 people in covered calls makes me feel like I'm making a little bit of a difference here. So hopefully it makes a difference in your life. Let's get going. Let's talk about the augmentation strategy. So let's rock and roll here by just getting right into it. So if you haven't watched any of my videos, you know that my cash flow machine program, and I have several different courses and masterminds and mentorships and things around that. But basically, it's all surrounded by this concept called the cash flow machine cornerstones. So it's the right stock. Like, this is not, don't just go out there and buy some cheap stock because you don't have a lot of money. Like, make sure you're buying quality. It's got to be the right stock in the right market. Not every market is good for doing cover calls or any kind of investing. Got to be the right market. That's kind of the tailwind that helps you invest. It's the right spot on the chart. Where's the right spot on the chart to be able to buy this? Because not every spot on the chart is right. Some are you think they're right and they're in decline. So it's got to be the right spot on the chart. And then we do what's called squeezing the juice. I'm going to be talking about the juice a lot. Essentially, if you don't know what we call in our program the juice, it's the time premium. And really, we're not about whether the stock goes up or the stock goes down, as you'll see. We're about collecting that juice, that time premium. So stick around with me through this, and I think you'll get it. You may have to watch like a little part of it twice because I'm not going to go through every concept, but I think I'm going to make it easy for you to understand if you're kind of new to this. So let's go. All right. So I believe in the concept of flow. So these are my two little penguins here, and they're seesawing, right? The market seesaws, it goes up and it goes down. And so you've got this working capital. So when the market's going up, you're making all this money, you're collecting the juice, you're collecting working capital, but you've got to maintain some working capital because you might have to spend some money on roll-ups. But you also can use some of that juice on buying more, actually, augmenting your position. So we're talking about strengthening our position, augmenting it, okay? And that creates even more stored value that when it goes back up the other side, the other penguin, the market keeps going up and you get to make even more money because now you've been positioned using the downside part of the cycle as your friend, okay? And, we call it in the system, we call it we're drinking lemonade. When the market goes down, it's pink lemonade, and then when the market goes up, we're making money, so it's yellow lemonade or whatever. But bottom line is, we like both sides of the market. Doesn't feel good when the market's going down sometimes if you're not positioned properly, but if you just know this is a long-term game, it does help. This is what happens in the market, right? The market goes up and the market goes down. And, you've got to learn to love all the cycles in the market, because all the cycles are actually really cool, right? Pink lemonade, red lemonade, or yellow lemonade, or whatever. So that's the goal, that we want to start to say, look, we don't just love it when the stock is going up. We like it when the stock goes down too. It's a mind shift. This whole system is about mind frame. So where do we start? Well, most people look at that and they go, that's what a stock does. It starts at 100 and it goes to 160. All right. Let's say over a period of 1.5 years or something like that. Well, that's pretty good. Like, you picked the right stock. That's great. You made like 60% in a 1.5 years or whatever. Okay. Most people, but if you've been in the market, you know that that's not a stock chart. That's a line, right? Stocks don't just go straight up like that. They squiggle. They squiggle like that. They go up and then they sell. And then, the people take the profit, and then other people come in and go, wow, it's a deal. And they go bid it even back up higher, and they, meet earnings expectations, and the stock goes back up and then it goes back down. That's what happens with the stock. On average, it might go up like that from 100 to 160, but generally it doesn't go straight up, as you know. Okay. Like, if you squint and you back way up from your chart, you're going to see that the stock might look like it's a straight line, but we're not squinting, right? We have to sit through these daily fluctuations. And here's an example of Apple over a 1.5 year period, roughly. Look, I mean, it doesn't go straight up. It went up from the beginning of the chart to the end of the chart, but it went up and then it pulled back, and then went up more and pulled back, and it went up and then went down and it went sideways, right? So there's no market the same, but over time, if you're in the right stock, this is what your chart is going to look like. Squiggly. All right. Now, we can use this over time to, let's call it our moving average, or our average of where the stock is going. And I want to illustrate now really deep, complex. Well, I call it complex, but it's only complex because if you're brand new to covered calls, there's a little bit more to it than just what I'm going to say. So apologize for that, but I can't appeal to everybody on every video. So this is a bit more advanced, maybe intermediate or advanced. All right. So we got our stock from 100 and it goes to 160. And let's just say this is a 1.5 years roughly. But within that 1.5 years, we have these little cycles, right? These little mini cycles. Maybe they're 12 weeks. So I'm going to make some assumptions. We're in the right stock. And now we think, the stock is going to go up. And within that period of time, we know it's going to go up and down and up and down and up and down. And so we have these little cycles of 12 weeks, right? And so we'll just say that we have 7 weeks so that you could see what this looks like over time. And so these little boxes represent 12 weeks cycles, mini cycles in that whole uptrend. Okay. So let's say we're in the right market timing and we're in a bullish trend, and the market's going up and our stock wants to go up and we're in the right stock, all those other things that we have to assume. And those are our 12-week boxes, right? There's 7 of them. Okay. So these are 12-week cycles, as you see. And then let's just say the stock is at $100. So we're getting 1% a week in juice. Now, you can decide whether you're going to go deep in the money to get your 1% or $1 a week in juice, or you're going to go out of the money to get your $1 a week in juice. You're going to go at the money. All those things end up working themselves out over time, as I think you'll see, but as I've mathematically proven in other videos. And so we've got this $1 per week in juice, which is about 1% on a $100 stock. And we're going to buy 1,000 shares. Okay. And then as the stock goes up, we're still going to try to maintain that 1% a week, but the stock price is higher through this period of time on average. So now let's say in that middle period, it goes to $1.30 a week. And then by the end of this period, over a year, 1.5 years, the stock is now at $150, $160, still making 1% a week in juice. But that number is a little bit higher. So those are the assumptions I'm using to kind of make my case here. Hopefully you're following with me. All right. So let's say we start with 1,000 shares. It's $100,000 and we're making $1 in juice per week per 1,000 shares. So we're making $12,000 in juice selling calls, and that's $12,000 total, right? Over the 12-week period of time, right? Makes sense. Same thing happens. Now, remember, during that 12-week cycle, we're going to try to encompass that we have a boom and a little bit of a bust within that mini cycle. Okay. So that's why I just kind of drew this little chart on there so that you see when it gets to the bottom, we're going to buy a little bit more. So let me show you how that works. So let's say we got 1,000 shares to start. Follow me right so far? Because if I lose you here, I'm losing you for the rest of the video. All right. We got 1,000 shares. We're making $1 a week in juice per share. It's $1,000 a week. All right. So we get this bottoming of the cycle. And so we, instead of just hoping and holding there, like that's what most people do. They buy the stock at 100 and they hope it goes to 160, but they don't have a strategy for how to make money on it in between like we do. And so we now are going to add some shares here. Let's call it at the bottom or somewhere in there, somewhere in that block. And so now we've got 1,100 shares. And so now instead of making, $1,000 a week, we're going to make $1,100 a week, right? 1,100 shares times $1, $1,100 a week. It's $13,200 over the 8-week period. All right, I'm gonna go a little faster now. Hopefully you're picking up what I'm putting down. All right, now we add another bit because the stock goes through its mini cycle, and when it's down, we're gonna add more. And so we're gonna now have 1,200 shares, $1,560 a week. That's $18,000 in total. And we're staying in this stock the whole time. It's not like we're getting out and getting back in. Then, go through another mini cycle, add another 100 shares. Now we got 1,300 shares, and now we're at $1.30 a week in juice because the stock price is higher overall. You can see that from when we started. And so now we're collecting about $20,000 per mini cycle, right? For 12 weeks. 1,400 shares we buy when the stock is declining, and now we're at 1,820 a week. And by the way, some of you are going to probably, if you're a troll and you want to troll me, that's fine. You're going to say, well, averaging down is a terrible strategy. Yes, it is. And in any other kind of investing, I would say, yes, it is. But we are picking good quality stocks. Not a single stock has ever gone out of business since I've been doing the cash flow machine, because we pick high quality, institutionally supported stocks. Every once in a while, every 25, 30 years, we're going to get an Enron, but that's such a black swan that we can't plan on it. We may get it. So put this don't average down rule aside, because I agree with you. But we're just going to be, through this mini cycle, we're going to be adding some shares. So go with me on this, all right? So we add another 100 shares, and now we're at $21,000 over the 12-week period. Okay. Now we're at 1,500 because we add another 100 shares, and you get the drift. Now we're at $27,000 for 12 weeks. And then, after we've been in this for more than almost a year and a half, we're at 1,600 shares, and we're making $2,400 a week and $28,800 over the 12-week period. I know that's a lot of numbers that I just read you. So hopefully you were able to follow it. And there's a lot of stuff on the screen, but I want you to kind of be with me on this. We're using the opportunities that the market's giving us to pull back and do a little sell-off to add, assuming, of course, the stock doesn't go out of business, assuming we're on an uptrend, assuming the market's good, assuming all these things. And generally, probably about a third or a half of the time, this is what the market does over time. Okay. And so now let me simplify this a little bit. Okay. So we've got our boxes there. We've got our 100 to 160. And let me just take away all the other stuff and say, okay, here's how much we made over each 12-week mini cycle. And I'm going to add all that stuff up. And we collected, I know you're not going to believe this because it's crazy. We collected $141,800 in juice. Holy moly. That's just the juice, making 1% a week. Okay. But we were adding to our shares. So now we've got $141,800 in juice. That's more than we even spent on the stock. But you know what? The stock is now worth $160, and we've got a bunch of shares. That stock is now worth $256,000 in stock value because we've got 1,600 shares. So if you take the whole portfolio over that period of time, we've collected $141,800 in juice, and we got $256,000 worth of stock value in our account. Now, we took that juice and we bought stock on it, right? What I do, and this doesn't land unless you've been in my system for a long time, is the stock is the stock. Like the stock is just the ticket to get into the stadium. Once you're in the stadium, you can go sit in any seat that you want. But the stock, you're going to have it for the next 10 years. But nonetheless, let's say we have to value it. And I'm just trying to give you okay, if you stop today, you'd have $256,000. Not too shabby. $141,800 was collected from the juice, right? And the stock value itself is now worth $256,000. It's just weird Mark Yegi math, but kind of follow me here on it. Bottom line, in my mind, since you still have the stock and now you can collect juice forever on it, as long as the stock is still good, you still got this stock value. Even if you stop adding shares to it, you've still got that stock value no matter what. As long as it keeps going up or doesn't go back down below that, you've still got 1,600 shares. All right. So it's basically $397,000 of total value. I know it's my math. Okay. I know the math is not 100% correct, but if I stop today, I would still have a bunch more money than when I started. And I still can, go back in and I'd still have that value that I could still sell against for the rest of my life kind of thing. All right. Okay, so what are 3 scenarios we want to compare? Well, the buy and hope scenario, which is you just buy it at 100 and you hope it goes to 160 and you have no strategy to manage it in between like most people. That's the buy and hope strategy. It's called buy and hold, but I really think it's buy and hope is not a strategy. It's buy and sell calls, which is covered call writing. It's a great strategy. It's conservative. It works really well. You know that if you're watching this stuff. This is a great conservative strategy used by Warren Buffett and a lot of really great investors. You buy and sell the calls. Pretty good. But when you augment, which is one of the things that we teach in the cash flow machine, and there's a lot more to it, by the way, than this, because there's lots of rules on what happens if it goes below a certain moving average, things like that. But just trying to clean it up and make it clear. You buy, you augment when the market sells off a little bit, and then you sell more calls against it. Now you have more calls to sell, right? Instead of 1,000 shares, we have 1,600 shares. So we're getting more per week. And if the stock keeps going up, we're now getting more in juice per share per week as well, if that makes sense. Okay, how do we compare the 3 scenarios? Well, if we buy and hope, we got a total value of 160,000. The market went in our favor. But if it didn't go up at all, we'd still have 100,000. We wouldn't have lost any money. Okay, let's just say if it, but in this case, it went up to 160,000. If we bought and sold the calls, we'd have $160,000 plus we'd have $78,000 worth of juice that we brought in extra on top of that. So that's $238,000. But when you buy and you augment and you sell calls, even if you just got the juice, not counting that you still own the stock, right? You get 141,800 in juice. You still have $56,000 worth of stock there. And, to me, it's got a value of 397,800. Pick any of the 3 values that you want and say, okay, that's all we're going to get. We're either going to, take all of our juice and buy $256,000 worth of stock, or we're just going to say we collected the juice and, and we're done, right? And you still could sell off the stock and that helped you buy the stock. Or you could say, listen, this is an asset that I now own. It's got a future value, right? It's got a present value of the future cash flows. So in my mind, and this is Mark Yegi math again, it's a value of 397,800. Okay. Pick any of the 3. Buy and hope worked in this case, but there's no strategy for income. Buy and sell calls worked in this case, but it's a really good strategy of $78,000 worth of juice just in not adding shares. But if you add shares, your juice goes up incredibly. And to me, that's the picture that gets painted with this. So I don't know if that made sense to you, but let me conclude by saying, listen, a simple covered call strategy works. The augmented cash flow machine strategy works better, right? But let me tell you this. When the stock is dropping, when the market is dropping and everybody on TV like Kramer is like, oh, this is a crappy market and the Fed is talking crap and like everything's negative. By the way, you should shut off your TV anyway. Then it's really hard to buy when things are dipping. Okay. Looking at my screen today and Tesla's off 2.5%. Okay. I'm not buying today, but if it drops another certain amount and it meets my trading plan's strategy, I'm going to add more, just like I outlined for you. And, not every day Tesla goes up, right? Some days it goes up and it goes up in a lot of days in a row. And some days it gives back. And that's kind of the way the market goes. So it's really hard to buy when a stock is dropping. And that's because emotions start to get in the way. You're like, oh my God, everybody's selling. Is it going to go to 0? Like your brain, it just freaks out. Emotions are like the worst thing that can happen to a trader. So you need a rule. You need a rule that says, whatever it is for you, a guideline, right? If the stock drops more than 5%, add 10% more. If the stock drops more than 10%, add 2%. Whatever it is, you got to have a rule that you do every time, because if you know over time, if you believe over time that you're in the right stock and it's not going to 0, and of course we never really know that, well, then you got to believe in yourself and you got to believe in your decisions. And the toughest time to believe in those decisions is when the market's going against you. but that's why we buy quality. That's why we have to have the right stock. And that's why we like market timing in our favor too. And, the other thing is that the stock could take a lot longer to go back up. Like I could tell you in 2022, we had a bear market. There weren't a lot of stocks that were going up the whole year, right? Everything was selling off. They weren't bouncing back, but they're bouncing back in 2023. And so sometimes it takes a little bit longer. Sometimes it takes a lot less, like in 2020. It took a lot less time for things to go up. Made a ton of money in 2020. Okay. So, that's the caveat on this, right? There's no free lunch on Wall Street. You're essentially using the juice to force feed your portfolio into growth when you augment, right? You're using a rule in your trading strategy, and the juice is the engine that's creating all of this. You're not taking money out of your wallet. You're taking money out of this working capital that's getting created through the selling of the calls, through the juice. And that juice is making you, because you have a rule, buy 100 shares more in this example, right? Or whatever the rule is for you. And so you're force feeding your portfolio into growth. That's the cool thing about this. But the real lesson here is that you shouldn't quit. Let me tell you why you don't quit. First of all, you don't quit. You don't get all those ups and down strategies that keep building on each other. That's obvious. The other one is this. If you get out of the market, you let the stock get a sign because it's over your strike price or whatever, which is what a lot of gurus in the in the covered call space say. Well, the problem is on Monday morning, because it expires on a Friday, and you get assigned on Monday morning, you're sitting there with a bunch of cash. Let's say the market opens up down. Okay, what do? Do you buy? Well, it's down. It's going to crash. So I buy. So you have decision fatigue that happens every time you get called out, and then you've got to have a rule of when you get back in. Most people don't even have a rule. They're like, they're freaked out. They're in cash. They're like, oh, I want to get back in. It's cheap, and they get caught in a downtrend. So the don't quit rule is this for me, and this is part of my trading plan, is that, look, I know the stock is going to go up and I know the stock is going to go down. I happen to be in Tesla and Apple, and those are two of the most popular stocks, and they're more volatile than your basic Exxon or IBM or whatever, right? And so I know those little swings both ways are going to be volatile. But if I don't quit, if I can keep collecting that juice every week, 1%, 2%, 4% a month, whatever it is, I know that juice will help me buy more shares so that when the market does move up, not only will I have more shares to sell against, but I'll be able to create more juice because the share price should be higher, meaning the juice should be higher. Like Tesla was, at the beginning of the year was paying $3 at the money in juice. And last week it was paying $15. Well, no, it wasn't 50, like $9 at the money in juice. That's triple the juice. Same number of shares, you get triple the money every week. So that's why I don't quit. All right. If you've sat here this long, congratulations and thank you. I mean, I know there's a lot that I threw at you. And I hope it helps because if you can transition your eyes, I'm a pilot, right? And when you come in for a landing, if you're watching right in front of the plane, you're gonna nail the nose wheel into the ground. But if you transition your eyes to the end of the runway, the horizon, right? Then you're going to settle down that plane and make a really soft landing because that's just you don't have to look right in front of the plane. You just have to look down the runway. And most people don't. They look, their lights are on in front of their car and they're looking in front of their car and they're like, oh my God. But they don't see the deer coming. That's, down the highway. They don't see the train coming, if you want to just keep mixing all these metaphors. So you've got to look down the road. This is a long-term strategy, right? If you're looking at this as a day trading strategy or a trading strategy, I think there's probably other ways that you can trade and day trade. I've never seen anybody day trade and be in the market, more than a couple of years. They always blow themselves up. But this is a long-term strategy. This is a strategy that you do for the rest of your life, and you create that income every week. It's not about whether the stock goes from 100 to 160, because we got to make 1% a week, which is 50% a year, roughly, on just the juice, even if the stock didn't go up, right? But the stock went to 160, so we got the benefit of the stock going up too, and we got the juice. That's the edge. That's the strategy. That's the gig. All right. Thank you so much for being here. Again, like, subscribe, tell your friends, whatever all that stuff is. It would really help me out and help me want to keep making these videos. But I'm so glad you're here. And, leave some comments in. If you got questions, maybe I can clear them up in the bottom here. And if not, I'll see you next time on this channel. See ya. Bye.
Hi,
Mark Yagi here, wealth architect and author of this book on my covered call investing system called the Cash Flow Machine. Listen, what you just saw is just one part of creating reliable income of 2 to 4% a month from the stock market. But you know, if it were that easy, then everyone would do it, right? If you want to learn how I create investment income the right way, then you need to learn and have a system with rules and what if strategies so that you can learn what I do when the market goes against me, what I do when the stock goes against me, how to adjust my trade so that it's always in a winning position, how much to risk, how to build a multi-million-dollar portfolio that creates income of $10,000, $20,000, or $30,000 a month in semi-passive income. And best of all, the whole cash flow machine system takes less than an hour a week to implement. Just go to cashflowmachine.io to learn more, or click this link for more videos, masterclasses, and free resources. See you there. The information you just heard is for education and information. This is not financial advice.